Question 1. Which of the following statements best describes the purpose of reinsurance in the insurance market? A. Reinsurance is used by insurance companies to increase their financial reserves for future claims. B. Reinsurance allows insurance companies to transfer part of their risk to other companies to reduce their exposure. C. Reinsurance is a tool for managing claims within a single insurance company, ensuring they have adequate coverage for high-loss claims. D. Reinsurance is only used by mutual insurers to reduce risk exposure when underwriting new policies. Answer. B. Explanation. Reinsurance is an essential tool for insurance companies, allowing them to transfer part of their risk to other insurance companies, often referred to as reinsurers. This helps insurers manage large claims or catastrophic events by reducing their exposure to risk. The purpose of reinsurance is not only to stabilize the financial situation of the insurer, but also to maintain solvency and underwrite new business without taking on excessive risk. While option is partially correct, it confuses the role of reinsurance with financial reserves. Option C is inaccurate, as reinsurance is typically used to transfer risk, not manage claims internally. Option D is incorrect, because reinsurance is used by various types of insurers, not just mutual insurers. Question 2. Scenario. Sarah, an insurance producer, is explaining the terms of a health insurance policy to a client. The client is concerned about the coinsurance provision, which is part of the policy. Sarah explains that coinsurance is the percentage of the medical expenses that the policyholder must pay after meeting their deductible. Which of the following statements would Sarah make that is most accurate? A. Coinsurance is the amount the insurer must pay after the deductible has been met. B. Coinsurance is the amount you pay before the deductible is satisfied. C. Coinsurance is the percentage of the medical expenses you will pay after meeting your deductible. D. Coinsurance is only applicable for hospital stays and is not relevant for outpatient services. Answer. C. Explanation. Coinsurance is a cost-sharing arrangement between the policyholder and the insurer, where the policyholder pays a specific percentage of covered medical expenses after they have met their deductible. The insurer pays the remaining percentage. Option is incorrect, as it describes the insurer's payment responsibility, not the policyholder's. Option B is incorrect, because coinsurance is applied after the deductible, not before. Option D is incorrect, because coinsurance applies to many services, not just hospital stays. Sarah's accurate explanation should focus on the post-deductible shared costs. Question 3. What is the primary difference between a unilateral and a bilateral contract in the context of insurance policies? A unilateral contract is legally binding only if both parties agree to the terms at the same time, while a bilateral contract does not require mutual agreement. B. A unilateral contract involves only one party's promise, whereas a bilateral contract involves mutual promises from both parties. C. A unilateral contract requires both parties to act in good faith, while a bilateral contract has no such requirement. D. A unilateral contract is enforceable even if only one party fulfills their obligation, while a bilateral contract requires both parties to fulfill their obligations. Answer. B. Explanation. In insurance, a unilateral contract refers to an agreement where only one party, the insurer, makes a promise to pay in the event of a covered loss, while the other party, the policyholder, is not required to do anything but pay premiums. A bilateral contract, on the other hand, requires mutual promises from both parties, such as the insurer promising coverage in exchange for the policyholder's promise to pay premiums. Option is incorrect, because it misrepresents the structure of unilateral contracts. Option C is inaccurate, as both types of contracts generally require good faith. Option D confuses the enforceability aspects of both types of contracts. Question 4. Which of the following best describes the role of the Maryland Insurance Administration? A. The MIA provides insurance companies with funding to pay for claims. B. The MIA regulates the operations of insurance producers and ensures consumer protection. C. The MIA sets the premium rates for health insurance policies in Maryland. D. The MIA is responsible for investigating fraudulent claims on behalf of insurers. Answer. B. Explanation. The Maryland Insurance Administration (MIA) is the regulatory authority that oversees the insurance industry in Maryland. Its role includes regulating insurance producers, ensuring consumer protection, enforcing insurance laws, and issuing licenses. The MIA does not set premium rates. Option C, as rates are generally determined by the insurers, subject to MIA approval for fairness. It also doesn't provide funding to insurance companies. Option A. Option D is partially correct in that the MIA oversees fraud prevention, but it doesn't investigate claims directly on behalf of insurers. Question 5. Which of the following types of insurance would most likely provide coverage for damage caused by flooding? A. Homeowners insurance policy HO3. B. Commercial property insurance. C. National Flood Insurance Program NFIP policy. D. Renters insurance policy. Answer: C. Explanation. The National Flood Insurance Program (NFIP) provides coverage specifically for damage caused by flooding, which is typically excluded under standard homeowners, commercial property, and renters insurance policies. Option is incorrect because flooding is generally excluded under standard homeowners policies. Option B does not typically cover floods unless a separate flood insurance policy is purchased. Option D is incorrect because renters insurance also typically excludes flooding, requiring a separate flood insurance policy if coverage is needed. Question 6. Scenario: Mr. Davis recently purchased a life insurance policy with a waiver of premium rider. He becomes disabled due to a car accident and can no longer work. Which of the following will happen as a result of this rider? A. Mr. Davis will be exempt from paying premiums on his policy for a specific period but must eventually pay them back. B. Mr. Davis will receive a lump sum payment from the insurer to cover all future premiums. C. Mr. Davis will no longer need to pay premiums as long as he remains disabled and the policy will stay in force. D. Mr. Davis will lose his life insurance policy if he remains disabled for more than 6 months. Answer: C. Explanation. The waiver of premium rider allows the policyholder to stop paying premiums if they become disabled and are unable to work while the life insurance policy remains in force. Option is incorrect because premiums do not need to be repaid under this rider. Option B is incorrect as the waiver of premium rider does not involve lump sum payments for future premiums. Option D is incorrect because the waiver of premium rider ensures that the policy remains active during the period of disability. Question 7. Which of the following statements is true regarding the underwriting process for life insurance policies? A. Underwriting only takes into account the applicant's medical history and family health background. B. The underwriting process is based on an applicant's health status, lifestyle factors, and financial needs. C. Underwriting for life insurance policies is only performed when the policyholder files claim. D. The underwriting process is one-time review and does not impact policy renewals or changes. Answer: B. Explanation. The underwriting process for life insurance considers a range of factors including the applicant's health status, lifestyle, e.g., smoking, alcohol use, and financial status. This comprehensive assessment helps determine the risk level and set appropriate premium rates. Option is incorrect because underwriting also includes factors like lifestyle and financial needs. Option C is inaccurate as underwriting is done before issuing the policy, not after claim is filed. Option D is incorrect because underwriting can affect the terms of policy renewals or adjustments. Question 8. What is the primary purpose of the Maryland insurance laws related to consumer protection? A. To ensure that insurers collect adequate premiums from consumers. B. To guarantee that insurance policies cover all types of risks, including those not explicitly listed in the policy. C. To provide regulations that protect consumers from unfair or deceptive practices in the insurance market. D. To ensure that insurance producers receive commissions for every policy sold. Answer: C. Explanation. The primary purpose of Maryland's consumer protection laws in the insurance industry is to prevent unfair or deceptive practices, ensuring that consumers are treated fairly by insurers and producers. Option is incorrect because the focus is on protecting consumers, not maximizing premiums. Option B is incorrect as not all risks are covered, yet exclusions are typically stated in the policy. Option D is incorrect because commissions are not the primary focus of consumer protection laws. Question 9. Which of the following best defines indemnity in the context of an insurance policy? A. The amount of insurance coverage available to the insured for legal defense costs. B. The obligation of the insurer to replace lost or damaged property with an equivalent value. C. The insured's duty to provide accurate and truthful information during the underwriting process. D. The principle of restoring the insured to the same financial position they were in before the loss occurred. Answer: D. Explanation. Indemnity is the principle that insurance policies are designed to restore the policyholder to the same financial position they were in before a loss without allowing for profit or extra compensation. Option is incorrect because indemnity does not specifically refer to legal defense costs. Option B misrepresents indemnity as it focuses on property replacement rather than financial restoration. Option C refers to a duty during underwriting, not indemnity. Question 10. Which of the following is an example of an unethical trade practice in the insurance industry? A. An insurance producer cross-selling a variety of policies to clients to meet their different needs. B. An insurance producer using misleading statements to induce a client to purchase a policy that is not suitable for their financial needs. C. An insurer refusing to provide coverage for a claim that falls within the policy's coverage limits. D. An insurer increasing premiums based on the claimant's past claims history. Answer B. Explanation. Using misleading statements to induce a client to purchase a policy that is not suitable for their financial needs is an example of an unethical trade practice. It is a violation of consumer protection laws and regulations that require fair and truthful marketing and sales practices. Option is acceptable as cross-selling when done ethically can be in the best interest of the client. Option C may not be unethical if the claim is excluded or falls outside the coverage terms. Option D is also not necessarily unethical as premium increases are typically based on risk factors, not purely on claim history. Question 11. Which of the following best describes the absolute liability insurance policy? A. The policy provides coverage only after the insured has been found legally responsible for a loss. B. The policy covers losses that result from negligent actions but excludes intentional acts. C. The policy provides coverage for all losses, regardless of fault or negligence. D. The policy covers losses for which the insured is legally liable under a contract. Answer C. Explanation. An absolute liability insurance policy provides coverage for all losses, regardless of fault or negligence. It is typically associated with activities that are inherently hazardous, such as operating nuclear plants or owning dangerous animals. Option is incorrect because it suggests a legal finding of fault is required. Option B focuses on negligence, while option C covers all types of liability, not just negligence. Option D refers to a different type of liability. Question 12. Scenario. Mrs. Lee is the primary beneficiary on her husband's life insurance policy. After her husband's death, she receives the policy's death benefit. What type of beneficiary is Mrs. Lee? A. Contingent beneficiary. B. Irrevocable beneficiary. C. Primary beneficiary. D. Secondary beneficiary. Answer C. Explanation. A primary beneficiary is the first individual or entity designated to receive the death benefit from a life insurance policy. In this case, Mrs. Lee is the primary beneficiary since she is the first to receive the death benefit. Option A refers to a beneficiary who would only receive the benefit if the primary beneficiary is not available. Option B refers to a beneficiary whose designation cannot be changed without their consent. Option D is a secondary or contingent beneficiary who would receive the death benefit only if the primary beneficiary is deceased. Question 13. Which of the following is an example of moral hazard in insurance? A. An individual purchasing insurance with the intent of committing fraud. B. The person failing to disclose a pre-existing medical condition when applying for health insurance. C. An individual engaging in risky behavior because they have insurance coverage. D. A policyholder making a claim for a loss that exceeds the actual damage caused. Answer C. Explanation. Moral hazard refers to a situation where an individual engages in risky behavior because they know they have insurance coverage to protect them. This can increase the likelihood of loss, as the individual does not bear the full financial consequences of their actions. Option is an example of insurance fraud, not moral hazard. Option B involves a misrepresentation but does not involve risky behavior due to insurance coverage. Option D describes a form of overstatement, not moral hazard. Question 14. Which of the following is true about a term life insurance policy? A. It provides coverage for a set period and has no cash value. B. It provides permanent coverage with no expiration date. C. It accumulates cash value over time, which can be borrowed against. D. It is more expensive than a whole life policy. Answer A. Explanation. A term life insurance policy provides coverage for a specific period, e.g. 10, 20, or 30 years, and does not accumulate cash value. Option B refers to a whole life insurance policy, which provides permanent coverage. Option C describes whole or universal life insurance, which does build cash value. Option D is incorrect because term life policies are generally less expensive than whole life policies due to their temporary nature. Question 15. Which of the following is an example of a peril that would likely be covered under a standard homeowner's insurance policy? A. Earthquake damage. B. Flood damage. C. Fire damage. D. Damage caused by negligence. Answer. C. Explanation. Fire damage is typically covered under a standard homeowner's insurance policy, as fire is a common peril included in these policies. Earthquake and flood damage options and B are usually excluded unless additional coverage is purchased. Option D is incorrect because negligence typically does not qualify as a covered peril. Question 16. Which of the following is considered an example of a broad homeowner's insurance policy? A. HO1 basic form. B. HO2 broad form. C. HO3 special form. D. HO4 renters insurance. Answer. B. Explanation. The HO2 policy broad form covers a range of named perils, including fire, theft, vandalism, and more. Option A refers to a HO1 policy, which covers only basic perils. Option C refers to an HO3 policy, which provides more comprehensive coverage for the structure, but not necessarily for personal belongings. Option D is a renter's policy, HO4, which is designed for tenants rather than homeowners. Question 17. Which of the following is a feature of universal life insurance? A. Fixed premium payments. B. Flexible premiums and death benefits. C. Only provides term coverage. D. No cash value accumulation. Answer. B. Explanation. Universal life insurance offers flexible premiums and death benefits. This flexibility allows policyholders to adjust their premiums and coverage levels within certain limits. Option A refers to whole life insurance, which has fixed premiums. Option C describes term life insurance, which only provides temporary coverage. Option D is incorrect because universal life insurance does accumulate cash value over time, similar to whole life insurance. Question 18. What does subrogation refer to in the context of an insurance policy? A. The process of the insurer paying the claim amount directly to the policyholder. B. The right of the insurer to recover claim payments from a third party that caused the loss. C. The process of cancelling a policy due to non-payment of premiums. D. The method used to set premiums based on the policyholder's claim history. Answer. B. Explanation. Subrogation is the process by which an insurer seeks to recover the claim payments from a third party who is legally responsible for causing the loss. Option is the general claims payment process, but it does not involve recovery from a third party. Option C refers to policy cancellation, not subrogation. Option D describes underwriting practices, not subrogation. Question 19. What type of coverage does medical payments in a homeowner's insurance policy typically provide? A. Coverage for medical expenses incurred by the homeowner or family members within the home. B. Coverage for medical expenses of guests injured on the property, regardless of fault. C. Coverage for medical expenses related to motor vehicle accidents. D. Coverage for long-term medical care for the policyholder. Answer. B. Explanation. Medical payments coverage in a homeowner's insurance policy typically covers the medical expenses of guests who are injured on the property, regardless of fault. This type of coverage is generally for small medical expenses and does not cover injuries to the homeowner or family members. Option A. Option C refers to auto insurance, not homeowner's insurance. Option D is incorrect as medical payments coverage is not for long-term care. Question 20. Which of the following is true about the insuring agreement in an insurance policy? A. It specifies the exclusions and limits of coverage. B. It is a written statement from the insurer regarding policyholder responsibilities. C. It outlines the insurer's promise to provide coverage in exchange for premiums. D. It lists the insurance producer's duties and commission structure. Answer. C. Explanation. The insuring agreement is the section of an insurance policy that outlines the insurer's promise to provide coverage in exchange for premiums. It sets forth the key terms of coverage, such as what risks are covered and the scope of protection. Option refers to exclusions and limits, which are typically covered in separate section. Option B is incorrect as it pertains more to disclosures or policyholder responsibilities, not the insuring agreement. Option D is about the producer's role, not the insuring agreement. Question 21. Which of the following is true about liability coverage in a homeowner's insurance policy? A. It only covers property damage caused by the insured. B. It includes coverage for injuries to others that occur on the insured's property. C. It only covers bodily injury to the insured's family members. D. It provides protection against theft and vandalism. Answer. B. Explanation. Liability coverage in a homeowner's insurance policy provides protection for injuries to others that occur on the insured's property as well as damages the insured is legally responsible for. Option is incorrect because liability includes both bodily injury and property damage to others. Option C is incorrect as liability does not typically cover injuries to the insured's family members. Option D pertains to property protection, not liability. Question 22. Scenario: an individual causes an accident while driving their personal vehicle resulting in property damage. Their personal auto insurance policy does not cover the damages, but they have a commercial auto policy that does. Which type of insurance covers the damage? A. Personal liability insurance. B. Commercial auto insurance. C. Homeowners insurance. D. Workers' compensation insurance. Answer: B. Explanation. Commercial auto insurance is designed to cover vehicles used for business purposes and provides coverage in the event of an accident involving such vehicles. In this case, the accident is covered by the commercial auto policy even though the vehicle is personally owned. Option A refers to personal liability, which generally doesn't cover auto accidents. Option C is incorrect because homeowners insurance covers property-related incidents, not car accidents. Option D is incorrect as workers' compensation covers workplace injuries. Question 23. Which of the following is the primary purpose of underwriting in the insurance process? A. To advertise the insurance product to potential clients. B. To evaluate the risks associated with insuring a particular individual or entity. C. To determine the claims payout in the event of a loss. D. To provide customer service to policyholders. Answer: B. Explanation. Underwriting is the process through which an insurer evaluates the risks associated with insuring a particular individual or entity. The underwriter assesses factors such as health, behavior, and previous claims history to determine whether to issue a policy and at what premium rate. Option A refers to marketing, not underwriting. Option C pertains to claims management, while option D is about customer service, which is separate from underwriting. Question 24. Which of the following is an example of replacement cost in an insurance policy? A. The amount it would cost to repair or replace an item without factoring in depreciation. B. The amount an insurer will pay for damaged property after considering depreciation. C. The amount an insurer will pay if the insured item is not repairable. D. The value of the property at the time the policy was issued. Answer A. Explanation. Replacement cost refers to the amount it would cost to repair or replace an item with a new one without considering depreciation. This ensures that the policyholder is reimbursed for the full cost of replacing the item. Option B refers to actual cash value, which accounts for depreciation. Option C applies to scenarios where an item cannot be repaired but doesn't address depreciation. Option D refers to the original value, which may not reflect current costs. Question 25. Which of the following is considered an excluded peril under a typical homeowner's insurance policy? A. Fire damage. B. Windstorm damage. C. Flood damage. D. Theft. Answer C. Explanation. Flood damage is typically excluded under standard homeowners insurance policies. Policyholders must purchase separate flood insurance to cover losses from flooding. Fire, windstorm, and theft are common covered perils. Exclusions can vary by policy, but flood coverage is usually excluded. Question 26. Which type of insurance policy would most likely provide coverage for business property, such as a building and inventory? A. Homeowners insurance. B. Business owners policy, BOP. C. Automobile insurance. D. Disability insurance. Answer B. Explanation. A business owner's policy, BOP, is designed to provide coverage for business property including buildings and inventory as well as liability for potential business-related risks. Option A refers to insurance for personal property, not business property. Option C is for automobile-related risks, and Option D is for covering income loss due to disability, not business property. Question 27. Which of the following best defines moral hazard? A. A situation where an insured person takes on more risk because they are protected by insurance. B. A situation where an insurer refuses to cover a claim due to misrepresentation. C. A situation where an insured person purposely causes damage to benefit from an insurance payout. D. A situation where the insurer charges high premiums due to high risk. Answer A. Explanation. Moral hazard occurs when an insured person takes on more risk because they know they have insurance protection. This can lead to an increased likelihood of a loss. Option B refers to insurance fraud, not moral hazard. Option C describes insurance fraud or intentional loss, while Option D describes underwriting practices and pricing, not moral hazard. Question 28 scenario. Mr. Johnson has a $1,000 deductible on his auto insurance policy. After an accident, his car repair costs $5,000. How much will Mr. Johnson pay out of pocket? A. $1,000. B. $5,000. C. $4,000. D. $6,000. Answer: C. Explanation. With a $1,000 deductible, Mr. Johnson will pay the first $1,000 of the repair costs. The insurer will then cover the remaining $4,000. Therefore, Mr. Johnson's out-of-pocket cost is $1,000. Option A represents the deductible, but the total cost is $5,000, so the insured pays the deductible and the rest is covered by the insurer. Option B is the total cost of repairs, not the amount Mr. Johnson pays. Option D is incorrect as the insurer covers the remaining amount after the deductible. Question 29. Which of the following is an example of a deductible in an insurance policy? A. The amount an insurer will pay for a claim. B. The amount the insured must pay out of pocket before the insurer begins to pay. C. The amount the insurer charges for each policy. D. The portion of the premium that the insured pays upfront. Answer: B. Explanation. A deductible is the amount the insured must pay out of pocket before the insurer starts paying for a claim. It helps reduce the number of small claims and ensures the policyholder shares in the cost of the loss. Option A refers to the insurer's portion of the claim, not the deductible. Option C refers to the premium cost, while Option D refers to the upfront payment of premiums. Question 30. Which of the following is typically covered under a comprehensive auto insurance policy? A. Damage to your vehicle caused by an accident. B. Damage to your vehicle caused by fire, theft, or vandalism. C. Damage to your vehicle caused by another driver's negligence. D. Damage to your vehicle caused by hitting an animal. Answer: B. Explanation. A comprehensive auto insurance policy covers damage to the vehicle caused by events such as fire, theft, vandalism, and weather-related incidents. Option A refers to collision insurance, which covers damage from accidents. Option C refers to liability insurance for damage caused by another driver's negligence. Option D is covered under both comprehensive and collision policies, depending on the specific incident.